Premier Path Wealth Partners is registered as an investment advisor with the United States Securities and Exchange Commission. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the firm has attained a particular level of skill or ability. The material discussed in this episode is provided for informational purposes only and should not be taken as tax, legal, or investment advice. Any market information is from sources deemed reliable and may be the opinions of investment professionals, but you should consult your financial advisor for further assistance. Past performance of investment, sector, or index is not indicative of future results. Please refer to Premier Path's disclosure documents for further information concerning specific products or services.
We all like to think of ourselves as logical, rational beings. We are all emotional. Every single one of us, and every business owner that says, hey, no, I'm not emotional. I can, when it comes down to this, and you've spent all this time building this and growing this, like you said, somebody makes a comment that's not well received, you'll have an emotional reaction to it for sure. And listen, when they're trying to pay a little bit less, or they're trying to increase their value in the transaction, there's another reason why you need an intermediary, you need an M&A advisor that we can buffer and hear those things.
Welcome back, everyone. Welcome back to the Premier Path podcast. Today's subject is going to be the exit of business. Beyond the business, we'll talk about a little bit about building value, preserving legacy, and transitioning on your terms. That's going to be the main focus, but it's focused primarily on the sale part. Today here we have joining me today is Scott Mashuda. We're discussing a topic that every business owner will face at some point in their journey. It's the transition of the business. Whether you're planning to sell in 2 years, 10 years, or don't see yourself stepping away anytime soon, the reality is that every business will eventually transition. The question isn't if it will happen, it's whether it happens on your terms. At Premier Path, we know that the most successful outcomes rarely happen by accident. They happen through thoughtful planning and often years and sometimes decades before a transaction ever takes place. That's why we're excited and want to welcome today's guest, Scott Mashuda. Quick background, Scott is the founder and managing director of REAG. It's an investment banking and advisory firm specializing in mergers and acquisitions, business valuation, and transition. For more than 2 decades, Scott has helped middle market business owners prepare for and navigate some of the most important decisions in their life, from building enterprise value to successfully executing the sale. Scott and I have worked together with business owners. I've always appreciated his practical approach to helping business owners understand not only what their business is worth, but what it takes to maximize that value and prepare for that transition. So Scott, thanks for joining us today.
Thanks for having me, Michael.
Great. Maybe you can give me and our audience a little bit more detail about REAG and your place. On the surface, I'm talking to, we're a wealth management firm here in New Jersey, the metropolitan area, close to the financial area where there are tons of investment bankers in sale. And I'm talking to somebody, ironically, that is from Western Pennsylvania, Ohio. But I think that somehow blends into your secret sauce, your culture of who you are. But maybe you can give us a little background on yourself and your firm.
Yeah, that's great. So as you mentioned, I'm a Western Pennsylvania, Pittsburgh kid, born and raised, but I live in Cleveland, Ohio right now with my wife and family. So Mid-Atlantic, Midwest has kind of always been home base. We do business throughout the United States for lower middle market companies. So call it 2 million in EBITDA up to 25 million in EBITDA. And if revenue is a little bit easier to translate, we'll say, 250 million in revenue is the top of what we can do here. But most of our deals are kind of, call it under 100 million enterprise value, right around 100 million is the high end of what we see. So a lot of stuff, 30, 50, 40 million enterprise value is a big piece of our world. So founder-owned, family-owned businesses, first-time institutional capital. is really where we spend about 80% of our time. So you mentioned kind of the Midwest values, Mid-Atlantic, that's kind of what makes REAG different is really, the people side of things. We spend a lot of time taking difficult, financial concepts and talking about them in what I call normal people terms. So we do a lot of blue collar type businesses, a lot of industry, a lot of manufacturing, B2B service. That's what our world is built around and where we feel very comfortable. And we relate well to those business owners that are in that space.
So distribution, building materials, manufacturing, rust, dust, and smoke, which we tend to have a lot of clients like that also. So
Yeah. Yeah. Well said. That's exactly where we play.
yeah, and I think it's your connection with those types of people that makes it real, not just the expertise. I'd like to jump into it and start talking about the sale. Now, we often talk, Scott, about readiness, but let's assume we always talk about is the market ready, is the owner ready, is the business ready? But let's assume that they are ready. And we know all the statistics out there. There's various forms of it, but I think something like $5 trillion in owner-led businesses are going to have a transition over the next 5, 6, 7 years. 92% of them will be transitioning because of closure, not actually sales. So the preparation, I think something that both of us are very proud of, and us working with clients for decades helps. But let's assume they're ready. We've done our job. They are ready to sell. One of the first questions they're always asking you is, what is it worth? Maybe people have told them what it's worth. What's the value? Maybe I've spoken to them about, okay, we ran a cash flow and here's your retirement income. Maybe retirement income doesn't matter and they're fortunate enough that this is a big legacy sale potentially, but they still want full value. You're always starting with value. And I was wondering, how do you approach that?
Yeah, that's a great question and a loaded question. And the way I think about value is it's an opinion, candidly. Price is a fact, but value is an opinion. So one of the things that we spend a lot of time, and this, the time that we spent together is really helping the business owner understand what they value in a transaction. And part of that is price, but there's a lot of other things, in terms of legacy, employees, these businesses that you and I talk about here at the beginning they're in small towns a lot of times. You have to go to church after the sale, you go to the grocery store, you're seen around the community and you want people to think highly of you and still, respect you. Your name maybe was on the door of that business for the longest time, and it might be after you exit. So, thinking about value in terms of things outside the purchase price is one thing that we really encourage business owners and their advisors to do before a transaction, before they take the steps to potentially exit. So I think if you spend that time, the satisfaction with the transaction goes way up post-close because you're really defining what your personal goal line looks like, and then you're moving the ball towards that personal goal line. But I think, the question that you're probably asking is really geared more towards purchase price and how do we think about advising the purchase price element of that value, because it's a big part of it. You value a lot of things as the owner, but if the numbers don't make sense, the math doesn't make sense, you're probably not going to move towards facilitating a transaction. And so when I think about price, it's really a risk versus return analysis for any buyer. And then, when you get into maximizing that price, it's what does the buyer value that allows them to pay a higher purchase price in exchange for the value that they're receiving from you. And so if you break down the purchase price equation, if you will, it's really, a multiple times normalized EBITDA. That's what a lot of folks are using. And so normalized EBITDA is essentially the return element of that risk versus return analysis. And then the multiple would signify the risk that they see in actually achieving that normalized EBITDA going forward. So if you perceive a high risk in the business, you might pay a lower multiple. Whereas if the risk is minimized or you feel very comfortable with that, earning stream going forward, you'd pay a higher multiple. And so you take the multiple times the normalized EBITDA, and you imply a purchase price for that company. And then obviously where it gets a little sticky is, folks have a lot of opinions, like I said, about value, and here's what we think it's worth. And it's with it being in the eyes of the beholder. And once you create the market, which you really have to do to answer the question firmly, the market will then tell you how it perceives value and what that number is actually going to be. So you can only really hit it within a range or give the seller some idea of how you expect the market to respond based on our experience in building these markets and what we see buyers value. And then you can kind of frame it in a little bit. But as you know, there could be a pretty wide range in terms of how it actually shakes out, and what buyers ultimately say about the business.
Understood. And you often say that price is important and we have to be within a range, but it typically isn't the only issue there. There are many other issues, as you just explained. So thanks for clarifying that. And you alluded to it a little bit, but on the what the multiple is, and ultimately you go to the market to see where that is, but there may be a range, but that range really varies too, depending if a company could be saying we're growing really well, but they have growth without structure, which is not scalable. And I'm assuming that the buyers recognize that. Maybe there's some other profit issues that they could be working on. So there's the math side of it, and then when you go to the market.
Absolutely. And understand that the multiples can be deceiving, right? You see a range of multiples. You don't know why somebody paid the multiple that they paid. So when you look at historical transactions, and it's one of the ways to try to help guide a business owner on what we expect the market to bear, is you don't know what the terms of that agreement were when you have the metrics of the transaction. So you might say, wow, this multiple is really high, but maybe there was a lot of seller financing. Maybe there was a giant earnout on it. Maybe there's very minimal cash at close. It doesn't necessarily mean that the quality of the underlying business or the quality of the underlying assets is what drove the multiple. It might be the fact that the buyer shifted the risk of the transaction over to the seller versus taking that risk on themselves. So that's that risk versus return analysis that I mentioned earlier, that really the buyer's doing. And as you kind of move risk back and forth across the table, the multiple changes and the value changes. So if the seller sets up a business where there's recurring revenue, it's very projectable into the future. As you said, there's growth within those earnings. It's recurring growth. I mean, it's diversified end markets. There's systems in place. It's well documented. I mean, you can see and you can hear as we're talking about that business, the risk going down, which implies a higher multiple and pushes that purchase price here, regardless of structure.
So probably not a good idea. I mean, you may know the range as a business owner and you've been hearing it for years, but it could be very different even within your sector.
It's one of the scariest things about a business owner when they initially reach out is, what do you think value is? What is value? How have you been advised on value? Because the other part of that, Michael, is that, when you're talking to your friends in the industry that maybe have already facilitated an exit, there's a little bit of bravado with what you got. What was the purchase price? What was the multiple? So most folks, when they talk about the transaction, they may exaggerate a little bit in terms of how it worked out for them with their friends. And we have to compete with that a little bit, because there's a pride element then if you're the business owner that's now thinking about selling, and that maybe one of your friends from the industry conference has suggested to you that they got a little higher multiple, and that may or may not fully reflect reality. So every business is different. I mean, businesses are very much like human beings. They're living, they're breathing, they're moving, we're all different. And, as you think about value, and that's the whole, game about creating competition. If you're the investment banker or you're the advisor, the M&A advisor that's building the market for this, you have to be able to bring to the table the buyers that will see the highest value in this particular company, in this particular business. And, understanding the business at that level, where then you can say, okay, I can go out there, bring these buyers, and then, oh, by the way, bring more than one, that creates competition in the deal and then forces the value up above a fair market basis into more of a strategic value. That really unlocks that premium multiple or that premium value for the seller. And that's really a large part of the value that folks like myself are bringing to the table in these transactions is not only our ability to, excuse me, discuss value and discuss the business with the seller, but how do we prepare that and present that in a way and locate those buyers that are going to maximize that opportunity so that we can actually unlock it for the client.
So yeah, bringing that marketplace really can change the whole dynamic of it beyond the valuation. Let's take, and we'll go back to that, but since we spoke about valuation and the math behind that, we've spoken a lot about quality of earnings. When should it be used? Should it always be used? Is this just for companies that have a multiple, typically, maybe not cash flow businesses that are one times revenue? But can you talk about quality of earnings, and if the buyer is doing a quality of earnings, why do I need one
as the seller? Yeah, and that, I think that's an important differentiation. Is there's really, sell side Q of E and buy side Q of E, and so when you're thinking about, should I do a sell side Q of E as a seller, I guess the typical answer that we'll give you is, most of the time we do advise that you do that. And the reason is, if you think about the way the sell side process works, when you hit the LOI stage, which is essentially the equivalent of reviewing your offers, reviewing your LOIs, once you as the seller accept that LOI, you go exclusive with that buyer. And so now you lose all of your leverage. All the leverage that you had before, where you can, say, hey, I have multiple potential buyers here. These are the things I want. These are the things I want to get. And, the buyers are competing for that deal and competing for that business. Now that you've locked up and gone exclusive, it's the opposite. The buyer is looking for all the reasons why maybe that the LOI that they gave to you won't hold up or won't stand up, because they gave it to you based on a certain premise. And so if you have that sell side Q of E done before you go into the process, you know what the weaknesses of the business are prior to going into the sell side process. So you can put them in your book, you put them in the materials at the very, very beginning. So now when the buyer goes into that exclusive period, they already know their LOI is already based on those weaknesses. They're not a surprise. Whereas if they gave you an LOI and they weren't aware of those things prior, now they're saying, hey, we gave you that LOI under this premise, but these things aren't holding up. They're not true based on the buy side quality of earnings that we're doing, right? So because we already did that up front and we shared that in the results of that, it's very, very clear that we can hold that value then on through till closing. And that's a big part of the game. What your LOI is and what you actually close at, you want that to be, that never goes up, I guess is what I'm saying. The buyer never dives into due diligence and comes back and says, hey, listen, this is a much better company than we thought. We're going to go ahead and up our LOI, because they're not competing with anybody at that point. Why would they do that? They've already, essentially won the deal. So that number only ever goes down, and that sell side Q of E that you did at the very, very beginning will help you hold that value, because you shared the good, the bad, and the ugly from the very, very beginning. So the trust is there. There's nothing breaking the trust that they're finding, and you're really able to hold that value on through close.
So just for people who don't know what quality of earnings, it's a fancier way of really reviewing the books beyond the normal accounting.
Yeah, I think that's fair. I mean, if you think about the equation that we talked about earlier, where it's a multiple times multiplied by some level of earnings, right? Normalized EBITDA typically. The quality of earnings really goes and tracks back that earnings that we're reporting, the earnings that we're using as value, and really speaks to the quality of that, right? Hence the name. Is it repeatable? Can we really feel comfortable buying this earnings level that we feel like it's going to continue on into the future? Because that's what you're buying, is the future of this business, not the past. But you have to look to the past to get an idea of what you believe the future is going to look like. And so we're really looking at the past, saying, hey, is it a one-time event that really drove this? Is this sustainable? How do we project this going forward? Is the accounting solid in how the numbers are reported, that we feel really good about the quality of these earnings that we're basing the valuation on? And there's a independent accounting firm, or an accounting firm, that is really opining to that versus, the folks like myself that are involved or the business owner themselves.
And the cost of that, and it seems like the cost, from your opinion, is worth it because you can't get that back after the LOI, and then.
Yeah, that's exactly right. I mean, sometimes there's sticker shock on these things because, they're not cheap. But if you think about it relative to the value that we're unlocking on the deal and the fact that every dollar that we're getting for you in a transaction is multiplied by some multiplier that we've been talking about, you really want to make sure that we feel good about those numbers because we're going to get that value back for you in the transaction, versus if you don't do it and the risk associated with that, in due diligence. So it's strongly recommended. There are deals where, you might say, hey, it might be a little bit too small. Maybe we don't go through that process, based on the cost. But most of the time for the deals that we're doing, which are lower middle market deals, $2-3 million in EBITDA plus, it makes a lot of sense.
No, that makes sense from a math standpoint. If you said $2 million in EBITDA and it was 5 times, and you can get another turn one
That's right.
time, 2 million. I don't think the Q of E is going to cost $2 million.
That's exactly right. It's easy math when you think about it that way.
Easy math.
And to your point earlier, right? That's the job of us as advisors. Yourself and me included is really kind of adding that perspective to the business owner when they look at that and say, "Man, that's a lot of money." Like, yeah, I understand, but you have to understand what we're doing here and why it really matters.
And seeing your weaknesses now, you may be on the path and you're like, okay, now we know how to negotiate against those weaknesses or make improvements over the next 6 months. But have you seen someone say, you know what, I'm going to put this on pause after looking at that and really looking at some structural changes that they need to make in their business in order to get a much better valuation? Do you sometimes recommend to the client that we pause this if it fits in with their timeline?
Yeah. So my hope is that we would figure those things out prior to spending the money on the Q of E. And I think what you're alluding to is a great point. Is when you think about the exit itself, a buyer's going to look back at 3 years historical financial statements, and then it might take 9 to 12 months to actually run a process and complete a transaction. So when you think about that, that's 3 to 4 years of information and time, plus if I'm the business owner and I have to stay post close for a period of time, whether that be 12 months, 24 months, something like that, you're talking 3, 4, 5 years in terms of a time frame. Now, if there's issues with the business that you have to fix prior to going to market, prior to showing the information to a buyer, because some of that you want to move off of that look back period, that 3-year look back period, if there's issues, right? So you have to fix them far enough out where there's a clean slate to look at when you're the buyer. There's obviously a story. If it's not, it doesn't have to be fully pushed off, but they want to see the results of those changes. You can't say, hey, we changed this last month and now we want to go to market. It's like, okay, what's the result of those changes going to be? That adds risk to the business. That lowers the multiple. So when you're thinking about a potential exit, it's really never too early to start this process. Start talking to your wealth advisor. Start talking to an investment banking group. Understand how a buyer's going to view your business based on the way you look right now. And there's folks like myself who are in the business of taking these things to market. We can look at that business, fairly inexpensively and quickly and say, hey, here's where I think your challenges are going to be. I think you should fix these items. You can get another turn of a multiple. You can get, a lot better valuation and a lot better, purchase price if you have these couple things fixed and changed prior to going to market. And, they may not be that difficult. So if you don't take that look early enough, then you get what you get because you're coming saying, hey, I want to exit right now. I don't have any time. I want to take the 9 to 12 months to market this thing, and the 12 to 24 after, I'm ready to go.
Yeah, you can make a lot of changes. If you had in your mind that a business owner can't think like potentially an executive at a public company. I've been planning for 65, 70, thinking much, much earlier so that you can, and we always say, run your business like you're going to sell it, even if you never do, there could be another type of transition. Maybe it's internal, maybe it's to the next generation. But if you're thinking, as you said, about those things, you're way ahead of it, and that's important. I think that's some of the success that we have in much in working with you, Scott, is that preparation in the process. Talk about the buyers. Now we have private equity, strategic, family offices. And I can't tell you, I've heard more than once from some of our clients, I don't want to deal with PE. They have a certain perception. So tell me what we should be thinking about when we have different buyers.
Yeah, it's a great question, and again, another loaded one. The private equity buyers that you mentioned, it's frustrating to me, candidly, to see the lack of education amongst business owners about private equity and the solutions that they provide. A lot of folks have, like you said, a negative connotation towards that industry, and when you think about it, they've raised a fund, they've raised capital for the purpose of acquiring companies, and a business owner is typically looking for capital, either for an exit or for growth. And so when you can marry these folks up, they're a perfect fit for each other in a lot of scenarios, a lot of situations. But the thing is, when business owners aren't thinking about their exits soon enough, a lot of times private equity may not be viable, right? Because a private equity group isn't the operator of that business necessarily. The business owner is the operator of that business post close for a 3 to 5 year hold time before that private equity wants to exit. So I think understanding as the business owner that it's not an infinite hold. That capital has to turn over again. So there will be an exit by the private equity group going forward. So when you know that and understand that ahead of time, and you know that you want to grow with them, you want to retain a portion of that equity, call it 20% or 30%, sell the majority to a private equity group, grow your equity share at a clip greater than what you could do it on your own with your limited resources and your limited capital. And that's really what it's all about, is saying, hey, I'm going to sell a portion of this business, keep my money in, and then that smaller piece of the pie that I retain is a lot of times worth more than the bigger piece of the pie that you sold to them initially. That's the proverbial second bite of the apple, if you will, that the business owner gets. And so that creates a huge winning outcome for that business owner in that scenario, but it doesn't provide the immediate exit that you think about when you think about selling the company. It's just a very different type of buyer. If you want, and then the other side of that is, the strategic acquirers that you talked about. A strategic acquirer will typically pay the most because they can unlock that strategic value that we talked about earlier, where maybe they don't need a duplication in human resources. They don't need a duplication in accounting and legal. They already have that in the existing company. And that's how we define a strategic acquirer. It's another company acquiring, that business. So they can strip out some of that cost. And when you think about the valuation formula that I gave you before, well, really, when you're stripping that cost out, you're upping that normalized EBITDA that they're buying, even if you keep the multiple the same, so they can afford to pay a little bit more. Now, they don't want to. They're not going to just say, hey, I'm going to pay more because this is the type of buyer that I am. There has to be competition in that deal, like we talked about. And if you can, as the investment banker, create that competition, then it forces them to pay a little bit more in order to win the deal. And they can afford to because the costs are coming out. So there are obviously situations then as well where a private equity group becomes a strategic acquirer because they have a platform in the space and they're looking to grow that platform. That platform is then the buyer, and then they're doing what they call an add-on acquisition. So again, there might be more of an immediate exit there for a business owner because that platform is acting as the strategic acquirer, and they already have the operator that's running that platform who's going to stay with them, through the growth plans that they have for the business. So, and then the last one that you mentioned was a family office. And the real difference here is, that there's a longer hold time versus that, 5 to 7 year hold time that we talked about for private equity. So the challenge with family offices, and there's a lot of great stuff about them, is that they're very unique, right? They're operating off of, high net worth or family money. And so they can buy how they want to buy. And there's not a standardized process, if you will, that private equity tends to use, where we as investment bankers understand the thought process of what they're trying to accomplish. It might be a little bit unique from family office to family office, and so it takes a little bit more time to sort through all of that and make sure that there's the right fit is there. And I think when you really go back and peel this all back and kind of think about the end result that the business owner wants at the very, very beginning, that's what we talked about, you and I, when we started this conversation, is as a business owner, you need to think about what you want to accomplish, what's important to you in a transaction, because these buyer types all buy very differently. And the things that are important to them and the things that they value are all very different. And so if at the end of the day, what is important to you in a transaction, you can build the company that provides the exit that you want based on the attributes that are interesting to that type of buyer. And that's really where exit planning really starts to take shape and really has its teeth, in my opinion.
It's interesting because you're really describing it. It's such a broad category, even private equity, and they're so different in what you're trying to accomplish. It may be good for the business owner, as you described, that, listen, I'm growing, but I don't have the infrastructure to make this scalable, and I'm looking for more expertise. And then by getting that private equity expertise, you're able to take a more profitable second, third bite of the apple. But then on the other hand, maybe your most important thing, thinking about your own employees and the community that you're in, ensuring that maybe you're going to be the platform for them, and that's important for you. So I love the way you didn't just stereotype each category.
Yeah, and I think again, it's not simply private equity. It's like folks think about their business potentially leaving their community. Well, I would argue that with a strategic acquirer, that could potentially be most likely, right? If they already have an existing facility, they already have operations somewhere else. Why are they acquiring you? Just because a strategic acquirer is acquiring you doesn't mean you're going to go away either. They might be buying you for that distribution, for that additional capacity that you have at your plant or at your facility, or because, you're on a different coast than they are and they want to have manufacturing in your geography because maybe you make something that's very heavy. And so transportation costs are a large portion of the costs of that product. So again, understanding why folks are buying, and that's the fit that we started talking about a little bit. As a business owner, you have to understand the potential fit. How is the buyer viewing you? What are their plans post close? You have every bit as much opportunity to interview and ask questions of the buyer to determine if they're the right fit for your business as they do of you. And you have to determine that before you sign that LOI and go exclusive with the buyer, to say, hey, is this the right group to carry on my legacy, to carry on what I've built with and spent the majority of my life building?
Well, my next question, I think you kind of just answered it, which was, why do I need an investment banker? Obviously, you're creating a marketplace, you're negotiating, but all these questions that I don't know where to, as much as I've been successfully running my business, unless you're a multiple entrepreneur and you've sold like 15 companies, this is your only sale. Why do I, beyond what I just described, and maybe there are some companies out there who say, you know what, I know my supplier for the last 15 years. I'm best friends with him. I'm okay with the price. Why don't I just go forward with that and don't need the banker?
Yeah, and unfortunately, you see that scenario and hear that scenario quite a bit, where maybe they've received an inquiry from a single party and gotten excited about it and say, I don't need these investment banking guys. They're expensive. I'll do this on my own and I'll be just fine. There's a couple flaws with that, but the big one is I can't tell you the number of times that I've heard that scenario and that seller, that business owner, has been left at the altar. As the onion gets peeled back and as, the buyer continues to review things, a lot of times that does not hold up all the way through till close. And it will, and then once you do it, I mean, it's an exhausting process. Anybody that has been through due diligence, anybody that's been through a deal, it's very, very involved and it's exhausting. And so your appetite to do a deal after that is usually pretty low. So if you go that route and it fails, you push off a deal a lot further into the future than maybe you should or you would like to. So if you look at hiring an investment banker or someone to, run that M&A process for you, one of the big things that we bring to the table is confidentiality, which is something you and I haven't talked about here yet today. Is that, a lot of times you don't want the employees to know, you don't want them to get scared, you don't want the customers to get nervous and wonder if their products are going to be supported into the future, and vendor relationships and things like that. And so it's really our job to maintain that confidentiality, to identify the buyers that are going to see the highest value. You have potentially the scenario that you talked about, Michael, was that you have a buyer that's shown an interest. It doesn't mean they're the best buyer for the business. It doesn't mean that they're the buyer that's going to unlock the things that you want to unlock for the business going forward and for yourself, right? The goals that we identified are the most important attributes for you of a transaction. It's just a buyer raising their hand. Is it the best one? Will they see the highest value in this company? I mean, that's really the job of the investment banker beyond the confidentiality element is, hey, identifying these folks and bringing them to the table confidentially to have a conversation about how they're perceiving value, what they like about this company, and what they think they could potentially do with it going forward, and how that's going to impact you, the employees, the customers, the vendors, and the business moving forward. And then presenting it to them in a way that really helps them understand it quickly, digest it, and offer you something that you probably wouldn't get without that competition from other buyers. And what I mean by that is, let's say you have 3 or 4 LOIs. They're all going to be very different because the person with the pen is very different who starts to sketch this thing out. And if you have somebody guiding them ahead of time saying, hey, they're going to say, how do I win this deal? How do I put my best foot forward? Well, we've had a lot of conversations with the business owner, and these are the things that they value. So I think to the extent that you can help them accomplish these things with your LOI, with your offer, you'll have the best chance. And so these LOIs come in hopefully pretty close to the objectives that the seller has outlined. And then we're kind of reviewing them saying, okay, how close are they? Where are they hitting? Where are they missing? And, how does the value compare to the other LOIs that we receive? Because it's all relative, right? It's like, it might be a great number, but if you have somebody else with a greater number, that number then becomes the great number. So what you're able to do is kind of go back and forth with these folks and say, hey, unfortunately, as of now, you're not winning this transaction. Maybe you can sharpen your pencil a little bit because it is coming down to price. Everybody's kind of giving this business owner the other things that they want. But you're third on price. So if you have the ability to sharpen your pencil and unlock a little bit more purchase price here, I would suggest that you do it if you want to win the deal, because as of now, it's not yours. And sometimes, a lot of times buyers are willing to do that. Maybe they're feeling out the market a little bit with their first LOI, and they're not going to, go all the way to their maximum unless they have to, because that competition is there. So again, it all just speaks to the value that the process is really bringing to the table. And, the M&A advisors are the ones running that process. And if you don't go through that formal process, you go forward with one single inquiry who came to you and said, hey, I'm interested in doing this. You're not going to have a mechanism in order to maximize that purchase price and maximize value, and the transactional risk of being left at the altar because you haven't, they don't fully understand the business before they make that offer to you is extremely high. So it's typically not a risk worth taking, and you're better off putting a team together and building the market that's able to, unlock and maximize value for you.
You've mentioned LOI. Can you talk about that typical transaction in terms of a timeline? And take me from beginning end. I know we spent some time saying that whatever that timeline is, you're much better off making sure that you've put in place for making sure the business was ready, you were ready, and that could be years or even decades. There's estate planning, which we're not talking about on this call, but if you could walk me through that and add an element of that confidentiality, because that strikes me as very important. Am I alone in this? I know that information has to get out. Am I bringing my CFO? When do I bring middle management? When am I having a conversation on the plant floor saying that we're going to be selling the company?
Yeah, there's a lot there, and I'll try to touch on as many of those as I can. But when you think about the moment that you hire an investment banker or an M&A advisor to run a sale, that is typically a 9 to 12 month process. So at least I tell our clients to expect a 12-month process. It may happen sooner than that. You might have an exit in 9 months, but it takes time to put all this together. So initially, we as advisors are putting together a blind profile, and you'll hear it referred to as a SIM, which is a confidential information memorandum. That is everything that you want to know about the business, or everything that a buyer would typically want to know to understand, is this an interesting opportunity or not? And so the blind profile is what we put out first, which is simply one page. It says, hey, here's what the company does. Here's the financial metrics of the business. And then for any additional information, come talk to REAG or the M&A advisor on the deal. And then it doesn't tell them who it is or any more information. That's why it's called a blind profile. And if you want more information, then you have to sign a non-disclosure agreement. If you sign a non-disclosure, which is put together by the seller's counsel, then we'll give you that confidential memorandum, which has a lot more information in it. And so you sign your NDA, you get the confidential memorandum. All that has been prepared in advance, by us and working with the business owner. You review that, and then we're looking at you saying, hey, can you give us some indication of interest, an IOI? Let us understand how you're thinking about value, what you plan on doing with this business going forward, how you see this fitting into your portfolio or into your existing company. What do you think this looks like for the business owner in terms of an exit? And, what are you thinking about in terms of price? And so that gives us really some insight into that particular buyer. And if you think about what we talked about earlier, the things that are important to the seller, we're kind of trying to see how close they are to that. This is before you're putting in a formal letter of intent, the LOI or the offer. And so at that point, you're going to eliminate some groups because you want to keep it tight. You want to keep it small. I mean, the process is designed as a funnel. You're trying to weed people out and groups out that aren't the right fit and get to that buyer that's the best buyer for the company that will unlock the most value. And so you've got to move people out. That allows you to share information with less people, which is preferred typically by the owner because you're trying to keep it tight. You're trying to keep it confidential. So you get past the IOI, you share additional information. You do a management meeting, you'll do a site visit. You don't want to be parading a whole bunch of people through there. You keep it tight. You do it in times where, you can keep it private. And then at that point, you're looking and saying, hey, it's time to make your offer. It's time to give us an LOI. And so you get to the LOI stage, and that's, as I mentioned earlier, where you're going to make your decision. You're going to go back and forth with folks, talk to them about what other folks are willing to do that they may not be willing to do. See if you can, get the highest and best out of each particular group that's interested in the company. And then the business owner or the seller will sign an LOI and go exclusive with that particular buyer that they've selected. And, when you go exclusive, that's the reason that there's exclusivity around that LOI is it's now everyone's going to have to start spending more money. Attorneys, accountants, like you said, buy side quality of earnings will be done. And a buyer doesn't want to spend that money unless they know that the deal is theirs, the rest of the way through. So, but again, that's really when that seller loses that leverage. So, at this stage of the game, where multiples are, due diligence can be 90 days to 120 days. There was a time when it was closer to 60, but that ship has sailed as multiples get pushed up and buyers have to be more aggressive in valuation to win the deal. They're going to take a little bit more time to do the due diligence and make sure They're comfortable with everything that they know about the business prior to closing. And so, that ends up giving you, a 9 to 12 month time frame before it's all said and done on the transaction side. So you can't snap your fingers and make this thing happen. It takes time to build the market. It takes time to get through due diligence, and sellers have to plan for that.
Great advice. Great advice. I could recall sharing something with you, and this happens all the time with our clients. They're constantly getting bombarded from offers from PE firms, calls all the time. And in particular, I had some clients that were doing a lot of prep work, and they're probably 7 years plus away from some transition, whether it's internal or a sale. And they actually get angry when they're getting all these solicitations prior. And you had some good advice. What do I do with those offers?
Yeah, that's great. Yeah, a lot of folks have a emotional reaction to those. It might be, well, who do they think they are? They think they're better than me. They can acquire me, because sometimes these are competitors of yours in the marketplace. And so the advice is not call them back. It's not engage in a conversation. Just put it in the drawer. Just put it in the drawer. Make a stack. Bring it to you. Bring it to your financial advisor at the end of the year and say, hey, these folks have expressed an interest in my company. And that allows you to start a conversation with them and say, okay, well, why does that you have that reaction to them? Right? It's like, well, okay, well, when is the right time? You don't want to sell right now, but when? Because you understand the timeline that they might not currently understand. So if it facilitates a conversation with their advisor on timing, well, they're not going to do this, or they're going to shut me down. Okay, so it's important to maintain, your existing location. They don't value employees the way I do. Okay, so a buyer for you, values the employees as the highest asset within the business. Like, you're starting to lay out that goal line that we talked about. What's important to you in a transaction? Because those items are there. A lot of times a seller comes to the table initially saying they want to sell, and the question is, what can I get for it? What is the price? There is so much more that business owner values that they just haven't thought about yet, or haven't had a conversation about. And putting those unsolicited offers in a drawer, bringing them to your annual meeting with your wealth advisor, and having a conversation about, where do we sit right now? What number do we actually need to exit? It might be a lot less than we think. This exit might not be as far off as we initially thought it was when we got that unsolicited offer, because we're not personally ready. But the business might be ready. The market might be ready. You might say to them, hey, can I have a conversation with my friend, over at REAG about this? They might be able to give you an idea of a couple things you could do to grow the value to the point where an exit would make sense. Or you'd hit your number. So I think the biggest piece of advice is don't throw them away. It gives a guy like myself an idea of buyers that see value in your company. It's a starting point of where we can go to build out a potential buyer footprint, a buyer profile. It allows you to have conversations with your advisory team about the business, about a potential exit, about a timeline. So once they sit in the drawer a little bit, you're not going to be so emotional with them next time you have a conversation about it. So just put them in the drawer. Don't react. Don't do anything. And then maybe once a year, sit down with your advisor and let them ask you some questions about it. The good advisors like yourself, they know where to take that conversation and how to start to think about, what an exit looks like.
Great advice. What are the biggest deal killers or snags that you always see in these sales process?
Oh man, how long do we have? How much
I
longer do
know.
you want to go on this one?
That is true.
Yeah.
Great.
It's, I think, unrealistic expectations. You have to say that one, right? Because there are the folks that don't spend the time to review the business with an advisory team ahead of time, don't have their hands around what value is reflected, by the asset that they're selling. That would be a big one. Any customer concentration issues They will come up at the time where you're thinking about an exit. It will make it difficult to maybe put a buyer group together for a business that's concentrated on one particular buyer. Think about the way folks buy and the types of buyers that we talked about earlier. It might force you into a strategic acquirer, because what's a concentration issue for you wouldn't be a concentration issue with them because they have an existing customer group that they would just push you into, and then hopefully that would blend out on the concentration, but they might not provide the other things that you want. So post COVID, there's also end market concentration, which has been introduced by buyers. It wasn't really such an issue pre-COVID. So any type of concentration issue, recurring revenues versus project-based revenues are obviously more highly valued. Higher margins versus commodity type of work is more highly valued. I mean, deal killers could come out of anywhere, and really, it's really about helping those buyers understand the business that they're reviewing and thinking about acquiring prior to going exclusive and prior to making that LOI, because it's not a deal killer if they're just funneling themselves out earlier because of it. Right? It becomes a deal killer once you sign that LOI and there's something that the buyer doesn't understand prior to going there that's unlocked and uncovered in due diligence. That's when it becomes a deal killer versus refining the market, if you will.
Great advice. In preparation for this deal, it can never be too soon or too early. And I'm coming back to readiness, and the area that we'll typically bring you in and on is the market ready, or is the business ready? We're also bringing in their key CPA to look at is the business ready? Does it have, is it structured in a way that we can attain the most value for there? What are the common key metrics or KPIs? And that's where I think our experience in knowing not only the process is so critical. Can you comment on any other metrics or KPIs that we should be focused on?
Yeah, I think that's tough. I mean, it's a lot of times industry specific when you're thinking about, value. We could try to take a look at a business and benchmark the company against the other company that may have transacted and what they got in terms of a multiple, and say, okay, how do we compare to them in terms of our cost of labor? For example, our cost of labor is much higher. Well, why? And then, you understand that really that's a process that a buyer is going to go through. And so really for us, it's looking at it through the eyes of the buyer, and then, the deals that have happened previously and comparing and contrasting to give some range or idea of value. And that's the exercise that we're going through. And usually there's a couple of things that will highlight themselves, but they're specific to each particular business. And there's some of the things that we talked about before about, concentration risk or maybe depth of the management team. One of the things, and I don't know if you can really call this a KPI, Michael, is like, can you take a 2-week vacation? Like, can you walk away for a month, and does that work? Is the management team there strong enough and capable enough? Because, if you think about it, we're using the word exit. That's the idea here. Regardless of what the point in time is, exit. And so others have to be there and have to be capable of running this business and managing this business and growing the business day to day. And so that's a little test I think that you can do as well to see if the business is at that point. If it's not, well, what does it need in order to do that? Is there, missing pieces on the personnel side that you need to backfill and really help get it to that point? So it's I think, go back to what you and I said a little while ago. It's really all about being willing to have these conversations and start these conversations with your advisory group and let folks take a look at what you're building. Even if you don't think it's built, that's okay. Get a perspective on, as you're building it, where are the holes that are outside of your glasses and your lens, which is very well entrenched into the business. Let's take a higher level view, a bigger picture view than maybe how you're thinking about the business day to day.
I think that's a great point, and something that even at Premier Path, we have a business advisory division, and a lot of times it is building out the leadership within the business, because the owner, through his own grit and hard work, has built something incredible, but he can't get away. The clients are all tied to him, and what you're really the most sellable businesses, and the ones that are worth the most are the ones often, as you say, can run without the owner, and that's because they developed it that way. And we haven't spoke much about, but I always, the softer side of things, and I'm sure you'll say that equally as important is the owner ready, and is their family ready, and the dynamics of that often, we're on top of for years and sometimes decades. We were with the consulting group, and I remember some of the language we were using with the owners. Questions like, tomorrow morning, you have no calls to make, no return orders, no acquisition meetings, no decisions to make. Clients are being well served. Are you anxious? Maybe I'll stop by the office, see how everyone's doing. Do you feel irrelevant? Maybe you're not ready. Or you were offered $10 million above the fair value of your company. The only catch is you can't, they're not asking you to stick around, not even as a consultant. How do you introduce yourself at a party after a sale? I mean, all these things. Who am I?
Yeah.
And your intent is important. Obviously, your family too. We've had a wife sit down with us and say, "Listen, I signed up, for better or worse, but not between 8 and 5." So we have to make sure the family's involved, and that's the family dynamics and everything else. I know our focus, and I think you'll say if those things aren't in place, it's going to be a lot tougher.
Yeah, I would even say that they're probably the most important.
Yeah.
If you don't know what you're gonna do post close, it's tough. You can only play so much golf. How many times I'm gonna play more golf? That gets old. You have to have something more than that you're kind of thinking about, and different reasoning. But yeah, the thing we didn't really touch on too, probably we would do a disservice if we didn't mention this on the way out, is the cultural fit of the buyers, that we're dealing with. You have to like these folks that are taking over. Like, if you don't like them, it's not happening. It's that simple. Are they going to fit in based on what you built, the culture that you have? And it's really a hard thing to get your hands around in terms of cultural fit, when you're transitioning your legacy and transitioning the business that you've built. And it kind of goes along to just feeling good about the whole thing. Like you mentioned, that everything's going to go the way you want it to go. So that just takes time. That takes spending time with the potential acquirer, and really being thoughtful about what you're seeing, what you're hearing, and what goes on there in between those walls. And I think it's no different than the personal side of the exit, like you just talked about. Being real with yourself, about what this means to you to be moving to the next chapter of your life, to be potentially closing this door and moving on to something else. It doesn't have to be fully closed. You can still be involved. And we talked about private equity and being involved, and we know how the time that you'll be involved post close, but you're going to whittle that down regardless of how long it is, whether it's, at close, 12 months after close, 24 months after close. The idea is we're working towards being less and less involved in this company. And I think what most business owners will find is they might not have all the answers when they start going through this. They typically don't. But other things, when you start getting time back and you start reallocating your most precious asset, which is your time, into other things, you start to discover things that you really enjoy, that you really like doing, that you'd like to spend more time doing if you had it, but you haven't had it. So you haven't had time to explore other things. You haven't had time to allocate to other things. Your sole focus has been this business for so many years. And that's really what this is all about, is we're starting to move the target a little bit. We're starting to think about things other than this business every single day. From the moment you wake up to the moment you go to bed, you're talking about other things. And that's part of it. That's what you talk about in a conversation. Like you said, how do you refer to yourself? How do you introduce yourself? I mean, it's your identity. So we're potentially changing our identity a little bit. We've done it multiple times throughout our life. We played sports at one time. We graduated high school at one time. We graduated maybe from a university, or, we established ourselves in a trade, and that's how we've identified ourselves with our career or whatever it might be. So we've done it before. We're resilient as human beings. We'll do it again, but we have to be proactive in doing that. It's not just gonna occur.
No, it's not a flip of the switch, and there's a process, and you need to get there. I like what you said too. It's liking the firm or company and individual that you're selling to. And how many times have I seen they like that person, but there was one off the cuff remark that didn't, you know, didn't work, and the whole deal was ruined. And I've seen you in action too, in being the partner and the sifter of that information back and forth that's come to some great conclusions. So I think that's important to talk about too.
Yeah, 100%. Everyone's emotions. I've said this before, probably a million times. I know I'll say it again, but we all like to think of ourselves as logical, rational beings. We are all emotional. Every single one of us, and every business owner that says, "Hey, no, I'm not emotional. I can," when it comes down to this, and you've spent all this time building this and growing this, like you said, somebody makes a comment that's not well received, you'll have an emotional reaction to it for sure. And listen, when they're trying to um, pay a little bit less, or they're trying to increase their value in the transaction, um, there's another reason why you need an intermediary, you need an M&A advisor that we can buffer and hear those things. Because as business owners, we're not all ready to hear those things about the baby being ugly, and maybe it's a beautiful baby, but it has a crooked toe. The crooked toe still upsets us when somebody talks about it. So yeah, it's a lot to go through. It's a big deal. We don't minimize the impact of that on us personally and our families and everything like that. So very, very emotional thing to do. And I know you're always willing to share your experience and talk to business owners about these things, because that's really what you're doing when you're putting your advisory team together. Is you're leaning on the experience of that team, the fact that this is what we do for a living. We've been there time and time again. We know when to react. We know when to be concerned about things. We know when they're casual comments and just let them go and move on. That's the advice that is just priceless, because it'll either help you continue to move forward and get this thing across the goal line, or you'll know that it's time to take it out behind the barn and shoot it. And those are decisions, I think, that having that experience behind you, just you'll make such much better decisions with that.
Well said, Scott. I think we covered a lot. We could have went a lot further, but thank you. I think the outcome really is that yes, it's a transaction, but it's more of a process, and the
100%.
best outcomes really start with planning way before the transition, and obviously successful ones. And it's about clarity. It's about you, yourself, your business, your family, everything that you've built, and that becomes your legacy. So thank you. I'd like to thank everyone for listening to our podcast. And Scott, once again, you're the best, and thank you for your sound advice today.
Thanks so much. Great being with you, Michael.
Take care.